they have the liabilities that are very liquid and non-price risky, so deposits, and they use them to fund very illiquid and price risky assets, and so they face there could be a materialization of the insolvency risk and thus all the systematic consequences on the whole economy through the banking system. Another important aspect is taxation, as the minimum liquid asset reserve obliged depository institution to actually purchase um, public claims rather than private one. And here on the right side, I have reported the US rule related to the minimum capital. That is basically a percentage that must be targeted based on transaction account that I will explain later what they are. Cash reserves are vaulting cash and cash deposits. Here I've reported the thresholds, and there is a period of computation of 14 days, a lag in between that was established in 1998 after the contemporaneous reserve accounting system was substituted by the lagged one, and also a period of maintenance, that is the period in which actually the depository institution has to respect such limit. An undershooting of maximum 4% is allowed, otherwise we will have some penalties, while overshooting is not desirable for bankers because of the opportunity cost of funds. The first type and the most important kind of depository institutions are commercial banks. They are the largest group and also the most diversified in terms of assets and liabilities. Um, they are divided into smaller banks that have a capital of below of 1 billion, which are sometimes called community banks because they are found in local context, and they concentrate more on residential mortgages. They have only a 8% market share, and this is because so their share is decreasing, and this is because of the emerging and acquisition waves of the last decades. Um, but also they benefit from higher margins because they face less severe competition. In fact, their existence is due to legislation that until recent prohibited large banks to diversify geographically. Those larger banks are sometimes called regional or super regional banks. They tend to concentrate more than the community banks on commercial and industrial loans, and they being not very geographically diversified, they have more less ability to collect deposits, and so they rely more on federal funds and international money centers. Sometimes such kind of banks are called money center bank, as they mostly rely on wholesale and borrowed funds. Um, Here on the right, I have put two arrows just to show you that securities are increasing, and they usually occupy 30% of total assets. And this is because of the global financial crisis, and because the commercial and industrial loans are decreasing due to the commercial paper directly issued by corporations. Now, about the liabilities and equity, um, it must be said that they have an high leverage. That means that 89% of liabilities I mean, 89% of total liabilities, sorry, that 89%, we have an 89% of liabilities to asset ratio. That means that assets are mostly funded through liabilities, and they are about 70% for 70% deposits. Deposits are divided into transaction account that are checkable account, so that do not imply fixed terms related to withdrawal or time of contract, and they are divided into interest bearing and non-interest bearing, because interest-bearing accounts have some sort of limitation. And the largest part of deposit is composed by non-transactional account that are non-checkable accounts. So that means that they have fixed terms related to withdraw and the time, and they are mainly composed of households and small retail savings and certificate of deposits that are usually below 100K, and that they are decreasing because of the competition from hedge funds. And also we have large certificate of deposits that are over 100K and negotiable, so they can be sold in the market. Um, Now, another important aspect which cover about 14% of the right side of the balance sheet is borrowing and liability funds. They are mainly interbank and repurchasing agreements, um, interbank market and repurchasing agreements that are short-term ways to obtain fund